Most people assume that as long as they are not doing anything wrong, their bank account is simply a private place where their money sits. But in 2026, that assumption has quietly changed for millions of pensioners across the United Kingdom. New laws are now in force. Banks have new responsibilities, and certain account behaviors that once went completely unnoticed are now being looked at very differently, not just by banks themselves, but in some cases by government departments as well. The truth is that most pensioners who find their account flagged have done absolutely nothing wrong. They were not trying to cheat the system. They did not know the rules had changed. And that is exactly the point of today's video. Because if you receive pension credit, housing benefit, or other means-tested support, or if you simply want to understand how your bank is looking at your account in 2026, there are 7 specific behaviors that can quietly trigger a flag or a review. And knowing about them in advance could save you a great deal of stress. Let us set some important context first. In December 2025, the Public Authorities Fraud, Error and Recovery Act came into force in the United Kingdom. This is significant legislation. It gives the Department for Work and Pensions, the DWP, expanded powers to work with banks and financial institutions to identify potential benefit overpayments and errors. This does not mean the DWP is scrolling through your shopping list or watching every penny you spend. That is not how it works, and it is important to be clear about that. What it does mean is that banks, specifically the UK's largest high street banks, may now be required to flag certain account conditions to help the DWP identify whether someone is receiving the correct level of support. The government's own figures show that overpayments across the benefit system totaled around £9.5 billion in the year to 2024 to 25. Ministers have described this crackdown as the biggest fraud prevention effort in a generation. And with pension credit claimants now numbering well over 1 million people, a figure that rose sharply after changes to the winter fuel payment, this area of policy is very much in the spotlight. The key thing to understand is this: a flag is not an accusation. A review is not a conviction. In all cases, a human decision-maker at the DWP is involved before any action is taken affecting your benefits. But a flag can lead to a letter, a phone call, or a request for documents. And for many pensioners, that can feel alarming and confusing. So let us walk through the 7 account behaviors that are most likely to attract attention in 2026. If you receive pension credit, your savings and capital are factored into your entitlement. The first £10,000 of savings is largely disregarded. Above that, every £500 of savings is treated as generating an extra pound per week of income in the means test. This is called tariff income. From January 2026, banks are formally required under the new legislation to flag accounts linked to means-tested benefits if the balance breaches relevant capital thresholds. This means that if your savings creep up, perhaps from an inheritance, the sale of a car, or simply money accumulating over time, your bank may flag this automatically, and the DWP may contact you to review your claim. Many pensioners are surprised to learn that this can happen even when they have done nothing dishonest. If you received a lump sum and simply forgot to report it, the system may now identify the discrepancy before you do. This is one of the more surprising entries on this list. Under the new framework, banks may flag accounts where the card is being used abroad for more than 4 consecutive weeks. This matters because means-tested benefits, such as pension credit, are generally intended for people who are habitually resident in the United Kingdom. If you take a longer holiday to visit family in Spain or spend an extended winter in a warmer country, your continued card use abroad can create a flag. This does not mean you are automatically losing your entitlement, but it may trigger a review of your circumstances, and depending on the situation, your ongoing eligibility could be affected. It is worth checking with the relevant benefit authority if you are planning an extended trip outside the UK. Banks have long had procedures around large cash withdrawals, but in 2026, these procedures have become more structured. If you visit a branch and wish to withdraw a substantial sum, generally anything in the region of £2,000 or more, you will typically be asked to give advance notice of 24 to 48 hours. You may also be asked what the money is for. This is not an invasion of your privacy. Banks now have specific duties under consumer duty regulations to protect customers, particularly older customers, from courier fraud and other scams where criminals pressure people into withdrawing cash. If the bank suspects you are being coerced, they are entitled to delay or pause the transaction. For benefit claimants, a sudden large withdrawal after a period of low account activity can also be flagged as inconsistent with your known financial profile. Again, this does not mean wrongdoing, but it is the kind of pattern the system is now designed to notice. This is something many pensioners do not think about until it happens. If an inheritance comes in, or the proceeds from selling a property or asset, or even a large gift, and that money arrives in an account linked to a means-tested benefit claim, it becomes capital that needs to be declared. The detail that often gets overlooked is this. Even if that money feels temporary, even if you are planning to pass it to a family member or use it for care costs, the DWP will generally count it as capital the moment it is in your account. If it pushes your total above the relevant threshold, your pension credit entitlement may reduce or stop. Under the new bank reporting arrangements, a significant incoming lump sum on an account linked to a means-tested claim is exactly the kind of signal the system may now pick up on. Reporting any such change promptly to the DWP is the safest course of action. This is where confusion often begins. Some pensioners who prefer to use cash have a habit of withdrawing the maximum amount their card allows each day. For many accounts, the daily ATM limit is somewhere between £200 and £500, depending on the bank. When someone consistently hits the top of their daily limit day after day, this creates an unusual pattern in the account. It can resemble behavior associated with financial exploitation, where someone is being pressured to keep draining their account. Banks are alert to this in 2026, and internal monitoring systems, some of which now use AI-assisted tools, can flag these patterns for review. If this is simply how you manage your money, you are unlikely to face any serious consequences. But you may receive a call from your bank, and in some cases where benefit payments are involved, a note may be passed to the relevant authorities. There is another point many people miss. If you are transferring money regularly between your own accounts or sending regular sums to a family member without any obvious explanation tied to your recorded income, this can be treated as unusual activity. In some cases, people move savings between accounts with the intention of keeping balances under certain thresholds. This is worth approaching carefully because deliberate structuring of finances to avoid capital limits can be viewed very seriously by the DWP. Rules can change over time, and the new legislation gives authorities greater scope to look at the broader financial picture of a claimant. Sending an occasional gift to a grandchild is not an issue. Regularly moving significant sums in a pattern that appears designed to reduce your visible savings is a different matter, and it is one that could raise questions. The final flag on this list is arguably the most common. If the income recorded on your benefit claim does not match the pattern of deposits going into your account, this inconsistency may be identified during a review. For example, if you do a small amount of paid work but did not report it, or if you receive regular payments from a family member that were not disclosed, the data the DWP now has access to, cross-referenced with your declared circumstances, may reveal a gap. This applies to HMRC interest reporting as well. If your savings accounts are generating interest and that interest pushes you above a threshold, HMRC reporting to the DWP may already create a flag before the bank checking measures even come into play. Consider the situation of a retired woman in her late 60s, living in the East Midlands, receiving pension credit. Her sister passed away and left her £22,000. She did not know she needed to report this straight away. The money sat in her account for 3 months before she mentioned it to her daughter. Under the new system, her bank may flag the incoming lump sum, and the DWP may write to her asking for an explanation. If she had reported the inheritance within the required timeframe, the process would have been straightforward. Depending on the amount, her pension credit entitlement might reduce or stop until the money is spent down. The key is always to report changes promptly. Now consider a retired man in his early 70s on pension credit who spent 6 weeks staying with his son in Portugal. His card was used abroad throughout that period. This may generate a flag for the DWP to review his UK residency status. He did nothing dishonest. But he was not aware that extended overseas use of his card could attract attention. A simple letter to clarify his circumstances would likely resolve the matter quickly. Finally, think about an older woman who prefers cash and has been withdrawing her daily ATM maximum for years. Her bank's monitoring system eventually flags the pattern as unusual. She receives a call from her bank to check she is not being financially exploited. This is actually the system working as intended. It is a protection measure, not an accusation. The detail that is genuinely overlooked by the majority of pensioners is that many of these flags relate to reporting obligations rather than anything dishonest. The DWP does not expect you to stay completely still financially. They expect you to keep them informed when your circumstances change. If your savings go up, tell them. If you receive a lump sum, tell them. If you go abroad for an extended period, check whether it affects your entitlement. The vast majority of problems in this area come not from any intention to deceive, but simply from not knowing the rules. It is also worth noting that the state pension itself is not included in the bank account checking measures under the new legislation. These checks apply specifically to means-tested benefits such as pension credit, housing benefit, and employment and support allowance. If you receive only the state pension and no means-tested support, your account is not within the scope of these particular new powers. If you currently receive pension credit or other means-tested benefits, the most important thing you can do is keep your records accurate and up to date. Any change in your circumstances, a change in savings, an incoming lump sum, a change in income, or a longer period abroad should be reported to the pension service promptly. You can do this by calling the pension service on 08007 310469 or through your online gov.uk account if you have one. If you receive a letter from the DWP asking for information, do not ignore it. Respond calmly and provide whatever documents they are asking for. Being asked to provide information is not the same as being accused of fraud. In most cases, it is simply a routine review. If you are unsure about how a change in your finances might affect your entitlement, organizations such as Age UK, Citizens Advice, or your local council's welfare rights team can help you work through your circumstances at no cost. The most important thing to take away from this video is that knowledge is your best protection. None of the 7 account behaviors we have covered today are reasons to panic. They are signals that certain situations may attract attention, and in most cases, simply staying informed and keeping the DWP up to date is all you need to do. If you receive a letter or a call, stay calm. Engage with it. Ask for help if you need it. The rules around pension credit and benefit entitlement can feel complicated, but you do not have to navigate them alone. There is support available to bring everything together. In 2026, new laws mean that banks can now flag certain account behaviors to the DWP where someone receives means-tested benefits. The 7 situations most likely to trigger attention are savings crossing key thresholds, extended card use abroad, sudden large cash withdrawals, significant lump sums arriving in your account, frequent maximum daily withdrawals, money moving between accounts in unusual patterns, and inconsistencies between your declared income and what your account activity shows. These flags do not mean wrongdoing. They mean the system may ask questions. The best response to all of them is the same. Report changes promptly, keep your records accurate, and seek help if you are unsure. If you found this video helpful, please do consider subscribing to the Retirement Money UK channel. We cover the topics that matter most to people at and approaching retirement, from state pension rules and DWP benefit changes to savings, taxes, and the practical financial questions that come with this stage of life. New videos are published regularly, and everyone is designed to keep you informed so that you can make confident, well-considered decisions about your money. Thank you for watching, and take good care.